Yeah, thanks very much, Dan, and thanks for everyone at Investing as well for hosting today. It's got a terrific lineup of speakers, and I'm excited to be part of the group. And it's a very exciting time in the market, of course. Market madness being the topic. It is what I've been speaking about in front of groups now for basically since September of last year. Usually we change up the topic that we're talking about, every month or two, depending on market conditions. But the backdrop of what's making us money in the market now hasn't changed for almost a year, and the variables just keep switching in and out. And so it's my great pleasure to talk to you about my favorite topic that I've ever presented, which is market madness. And Dan talked about, I probably need to update my introduction because the most recent crashes that we've actually gotten major exit signals on was back in July of last year, and again in December at the end of last year, where we were able to capture sort of significant moves to the downside, looking at the factors that I'm going to be talking to you about today. When we obviously get towards the end, we're going to be looking at live markets, and I'm going to be sharing with you a strategy that predicts the S&P 500 up to about 80% accuracy, back tested over the last 3 years, and it is deadly accurate. And today is the next day, which is an indicator in that strategy. So this is the perfect time to be talking about that. So make sure you stick around until the end. So today, let's talk about the agenda. As an educator, I like to really empower people with the why behind the what. And I spoke to a student out of Australia the other day who just bought a $10,000 day trading package a year ago, and he'd gone through everything. But he said a year later he bought all these bells and whistles and all these software programs and technical indicators, but he didn't understand anything about why they worked. And because he didn't understand why they worked and didn't understand how to make the decisions himself, he never had any confidence in the system, and felt he was completely reliant on the educator in question's alerts. And so he was just lost and dependent. So whenever I teach anything, I believe it's critically important to understand the DNA or the blueprint behind what makes things tick. If you have an intimate understanding of that, then you're empowered, then you're confident, and God forbid if I get hit by a bus tomorrow, it shouldn't affect your bottom line. So the decision tree that we want to go through today is to take you down through why a certain strategy is best, how we make those decisions from a yes-no strategic and quantifiable way, instead of just saying, I think the market's going up because of what Obama's going to do with healthcare, or down because of healthcare, or Trump's going to get in or out, or the talking heads are saying this on TV, therefore my opinion is this. In my opinion, opinions have no place in the stock market. As technical traders, I believe that our decisions should be can only be replicated to create consistent profits if we make consistent decision-making processes. And the only way we can do that is if we make decisions through measurements, through numbers, through things that aren't subjective. So we're going to go through the process of how we build those things out, and look at the critical things that we need to identify in a trade before we take one, which is whether we're dealing with oscillating or momentum trades, and the differences and how to profit from them. Of course, how to identify when trends truly start and end, and why most people, even experienced traders, get that wrong. And then we're going to be going into some of my favorite indicators, most importantly of which in terms of today, a strategy called open range, which will blow your mind in terms of the S&P 500. So let's get back to let's get into things. So as I mentioned before, talking about rules. A lot of people fail in the stock market because they fail to take action. They do not take action. Does anyone feel that way? That a lot of the time you miss lots of good trades, or you hold on to losses much longer than you should because you know what you should do, but just don't do it. Does anyone feel that way? That when we did a customer survey of new students signing on with us over the last few months, we had over 1,000 new students that came on board with us in the last couple of months that we surveyed, and overwhelmingly, a lot of people said that the things that they needed the most was they were holding on to losses too long, and they were cutting their profits too short, and they didn't have a simple strategy to follow. So we observed that the main rules that people were, the main problems people were having is that they didn't have rules. So they didn't have a way of saying, this is where I get in, this is where I get out, no matter what. Or they had rules and they had no confidence in them. Some of the other problems were that people had rules, but they didn't really understand them well enough. So they didn't necessarily believe the rules they were being taught, or they didn't believe that the market could be predicted that well. Or worst of all, they just didn't believe that they could do it. They had no confidence in themselves because they just had so many past failures, whether it be in the stock market or futures or real estate or whatever, that people, it was easy to say that I just can't do it than to figure out how. So these are the psychological objections that we want to overcome today by creating that confidence in the structure of the market first and foremost, and then we're going to break into applying that to today's market in this session. So let's go through the process. Let's start out at the basics and then work down to the most advanced. Firstly, how do you make your decisions? How do most people here decide if we were to sit down? How do we find a good opportunity to trade today? A lot of people obviously use news. Most active stocks that are announcing earnings, things like that, things in the media, tips from friends, newsletters, brokers, financial advisors. Things you're familiar with. That's a photo of Vancouver, actually. That's where our office is, right there. And this is all good. This is all fine. But when you're getting ideas from a plethora of different sources, how do you take those and decide whether they're valid or not? Because if you're getting a lot of different sources, then they're all going to come with different ingredients. They're all going to be different types of trades. They're all going to have different reasons for why they're good. And from a technical standpoint, there's over 100 different stock patterns in the market. So you're going to be exposed to all of those. But do you want to trade 100 patterns? Or do you want to specialize in the top 5 that are the most predictable and the most profitable? So I guess what I'm saying is, when we get these different sources of ideas, what do we do with them? How do we take them through a funnel and say, right, at the very first point, does it even meet the structure that we're looking for to even spend more than 10 seconds analyzing it? So what is that funnel? Most people's funnel is emotional. And that's where the lack of strategy really hurts you, because you fail to limit losses. The stock goes down, and because you didn't have a set stop loss in place, it's gone through support, and then you say, oh, well, it's only another 7% away till the next support. I'll just hold it until then. Because it's a great story, and hey, Jim Cramer, he's long the stock, and he can't be wrong, can he? He's on TV. And then so maybe then you average down. You say, well, I don't really want a loss, so I'll just buy more stock at this lower price, and then when the support hits in, then I'll be able to factor in the extra risk I ended up taking. Bad decision. Well, then maybe you buy into emotion. Maybe you missed the trade. Maybe you were late getting up and you said, I'm going to buy that if it hits $4. You wake up a little bit late, or you're a little bit nervous getting into the trade and pulling the trigger. The stock's all of a sudden up already 6%, and you get into it anyway. Bad decision. Believing in public information. The hype. Bad decision. So all of these things are emotional, and this is perhaps why 95% of people lose money. Because statistically speaking, if you just threw darts at a dartboard, if you gave a monkey the darts and he could manage to throw them at the dartboard, wouldn't you have, I mean, all things even, a 50% chance of making money? The stock will eventually go up or down. 50-50. Flip a coin. So why do 95% of people lose money? Because we all share something in common. We all share emotions and lack a strategy. So the job of the stock market, being one of the best run businesses in the world, is to part you from your money by knowing how you will trade, by knowing where your stops will be, by knowing what type of pattern will lure you in to buy at the top so that the smart money can sell their position to you. So I guess one of the most important questions I usually ask people, no matter what experience level, when I'm first introduced to them through Acorn, is I ask, and I'll ask you the same question. If I were to give you a pen and a piece of paper, and I were to ask you to draw down exactly what the perfect stock would look like. So let's say I said, okay, draw this for me, draw the perfect stock that you would want to trade every single day. What would it look like? Do you know what that looks like? Or is that something that you're still trying to figure out? And if you could give me that picture, I could go away and find 100 of those for you, or one every day. What would you draw? So a lot of the common answers are an uptrending stock, or a stock above its moving averages, or things like that. But what I really mean is something a lot more in-depth than that. I mean, when you're looking at a perfect stock, I mean look at the exact recipe. So, for example, for people that say I want a stock in an uptrend, well, the problem with that is that not all uptrends are things you want to buy. So, quick question to the audience. We're all technically savvy here, right? What is the definition of an uptrend, everyone? What's the technical definition of an uptrend? Higher highs and higher lows. But, let me change pen color here. All right, but let's say the stock is making higher highs and higher lows, but it's contracting in range. Is that an uptrend that you would buy? I hope not, because that is a rising wedge, and that is bearish, and that has over a 65% chance of breaking down after 3 touches of support. Okay, what if it wasn't contracting range? What if it was even? But let's say that the stock closed lower and lower in the range. Is that an uptrend you would buy? Absolutely not. What if, as it went up and did that, what if the volume was going lower and lower and lower on each candle? Is that an uptrend you would buy? No. In fact, if we combined all 3 of those things, if we had a contracting range with lower closes in the range, with decreasing volume, we've actually now defined exactly what we would draw for a perfect short. That would be a rising wedge pattern with low closes showing selling dominance, with lower volume, which means decreasing momentum. Now, if we were to combine the fact that we were also heading into double top resistance, and that we were above the Bollinger Band, that money flow was going down, that the insiders were selling, that the P/E ratio was 100, that they declare no dividends, that the weekly chart is a head and shoulders, that the MACD is negative. If we were to start adding all these other ingredients, now what we've done is we've described a perfect short. Hey, let's throw in another one. Let's say the institutions are selling as well. let's say that the 50% of the insider ownership is getting out. What we've now described are kind of like the ideal conditions of it. If you could say the perfect short, what would that look like? And write that down, then you've got a great trade. Why not trade that? So that's what we want to start getting to if we're going to be, if we're going to start to seek exceptional results, is to figure out what that recipe looks like and find it. So most people don't do that. Most people are just simply trading whatever comes to them and evaluating every stock on a stock-by-stock basis, scrambling between the indicators that they have been taught or are trying to understand. And the problem with that is if you don't know where you're going, then any road will take you there, and you end up just trading everything with a real lack of success. So let's talk about how, so if that's the case, what is the best strategy? What is the best recipe? Well, firstly, to do that, let's first understand what controls the market. Now, what has always controlled the market is volume, because buying versus, supply versus demand is what drives stocks up and down, or more basically, volume. So who dictates volume? Well, 30 years ago, you dictated volume. 30 years ago, you would research the company by reading the newspaper, watching the television, listening to the radio. Then you'd get up and you'd pick up your pulse-style telephone and you'd, ring your finger around the machine until you got on the phone to your broker. You talk to good old Jim down at Wood Gundy or Merrill Lynch. You'd have a chat to him, and maybe by the end of the week, you would end up owning a stock. Now, that's why markets were fundamentally driven back then, and that's why you didn't see the huge levels of volatility that we see now, because people made investments. These days, the volume does not come from you. Now, the volume comes from smart money. 3 years ago, they estimated that 70 to 80% of volume came from high-frequency trading, which is basically meaning that 80% of the decisions are made by computers with no human sitting behind them pushing the button. Excuse me. That figure is now estimated to be as much as 90%. In fact, I was living down in Mexico, in Playa del Carmen, for 4 months of this year, actually, and one of the gentlemen that I spent a lot of time with down there is one of the partners in one of these firms, and his firm alone represents 10% of everything bought and sold in the US markets per day. So 1 in 10 stock that's bought comes from a computer in one of his offices deciding to buy and sell based on an algorithm. So bots make decisions on preset rules, and billions of dollars are made from it. Some firms have reported not having a loss 16 months in a row. There's a great 60 Minutes video that you can look up called High Frequency Trading if you ever want to look at those types of reports. So the force that you can, the amount of power that you control when you are the smart money is amazing. Think about the flash crash of 2010. We're talking about trillions of dollars going through the market that saw 3 months of growth plunge in about 5-6 minutes and then come back just as quickly. The flash crash. So the smart money can send the market basically wherever it wants, because it is the market. It is 90% of the volume. So it only makes sense to me to say, well, what I think about the market really doesn't matter. My opinion is the least important one. Now, whether I agree with it or not, the opinion that matters most is the smart money's. Because if they want to drive something up, they will. I mean, who here has been waiting for the market to crash since 2012? How many people have thought that another 2008-like plunge should have happened a while ago? Yeah, me too. So that's my opinion. And that's what most economists, very well, decorated Harvard professors, the history of money, what's his name, Nigel, I forget his last name. Anyway, very, very, very smart people said this market's ready for doomsday. But that doesn't matter because the market kept on going up. So what we have to do is we have to kind of put opinions aside and again look at what the rules tell us. So what do the rules tell us? Well, the beautiful thing about high frequency trading is that it's really not that smart. It's far more difficult to figure out whether Apple's a great company or not, or the quality of a CEO, than it is to figure out a pattern that has very basic rules to follow. The difference is people get confused because there's so many patterns. It's like two football teams, a coach standing on the edge, coaching the Broncos, saying, right, we've got a playbook with 200 different plays that we could go here. We're going to do a Hail Mary, we're going to do this play, etc. And the job of a good team is to consistently keep changing up their play to keep the other team confused. And as soon as the other team thinks they know what the play is, they change it. So the job of the stock market is to keep cycling through these 100 patterns to keep you in the dark. And as soon as you figure it out, that's when it changes. But if we know how to detect the fingerprint of these patterns and predict them versus react to them, then that's where a huge edge can come in. So how do we do that? Let's go one layer deeper. Well, firstly, one of the most important things that I believe is that is the idea of support and resistance and properly identifying it. Because I believe that nothing in the market, whether it's a stock, an index, whether it's foreign exchange, futures, anything that moves in the money markets will not change direction unless it hits one of these following few things: horizontal support and resistance, trend line resistance, or moving averages. Now, there might be a fundamental reason why a stock gaps up 20%, but I believe it'll gap up 20% to wherever the Fibonacci level is, or where the horizontal level is, or where the moving average is. It won't gap up into thin air. So the places where movement will happen to and from are already predefined in a chart. So let's talk about that right now. Let's go over to to charts. And let's start with the 2008 market crash, because over the years I've heard so many people talk about how chaotic that was and how no one could have predicted this. I mean, that's what you hear in the news anyway. But that's a bunch of you-know-what, because it was very predictable. We predicted it, and just little old Acorn. So let's have a look at how you could have done that, because it's very applicable to what's going on today. So when you look at a chart, I asked you this before, if I were to bring up a chart of anything, I was to say, okay, here's Facebook, here's Amazon, here's IBM. Are you going to go long or are you going to go short? What would be the first thing you would look at to decide what that stock is doing and whether you're long or short? What would everyone here look at? What would be the first thing? Is it moving averages? Is it earnings? Is it fundamentals? What would you look at in your first step of your process, of your checklist? Trend lines, okay? Trend, divergences, all right? So I agree. The most important thing, the absolute most important thing to look at when you first look at a stock is not the candles, it's not the moving averages, it's basically to see where is support and resistance. Now, the reason why is once we have determined where support and resistance is, we know what the pattern is. So once we know where support and resistance is, we can take the stock off and we're left with the pattern. So with the S&P 500, in January 2004 through to November 2004, the index was clearly in a downward channel. A downward channel is bullish. So after 3 touches of resistance, 1, 2, 3, we're then expecting the breakout, and then we're going long. And so when it breaks out, we're then long the S&P 500. So no matter what's going on fundamentally, that's an easy decision to make because that's what the rules tested over thousands and thousands of trades over many, many years tell us to do. So why go against probability? So then we're long. Now, you might ask me, why is it important to, what's 2004 got to do with 2008? Well, the other thing that I wanted to talk to you about today is, of course, how to know when to start identifying support and resistance. Because how many people struggle with this? How many people look at a chart, how many people look at a chart and say, well, but how do you know where to start a trend line? Why isn't it there to there? Or what about here to here? Or maybe it's this. Or is it this? Or is it this? Like how many? Or is it this? I mean, you could go nuts. How many people struggle with that? So you know what bad traders say? Sorry, I don't mean to call you a bad trader if you're one of those. You're not. But bad traders make this excuse. Good traders figure out how to overcome that problem. Bad traders say, well, yeah, you never really can figure it out because trend lines are subjective. Rubbish. Trend lines aren't subjective because trend lines come from algorithms. Algorithms make decisions with rules. If you know the rules, then you would draw them the same way the algorithms would be. Now, there's obviously some variance. There's never an absolute 100% answer. But there is a strategy of how you should draw them so that you're doing it the way that high-frequency traders have predefined them. That's the rules. That's what you need to follow. So the way we need to do is we need to go from left to right. And if we go left to right, we're connecting the most immediate tops and bottoms, and then as soon as that trend is broken, a new trend starts. So that downtrend was over here, which tells us to look for the new trend there. That means we're immediately connecting the highs and lows of the following candle. So 1, 2, bang. Now we have the gradient of our top line, and as soon as we have that line, which we would as of here, then we can immediately copy and drag that and duplicate it on our first reversal on the bottom, which is there. So then we go down to here. I'm not sure why that's not working. Just 1 second. Doesn't seem to want to play ball. Sorry, 1 second here. All right, so what happens is we end up getting a trend line that we can then duplicate, put it parallel to the top one, and then we have our pattern. And then we get confirmation of that, the second reversal that happens up here in November. So, again, why is that valuable? Because then what we see is that this trend is then broken there. In October 2006, we have the break. So again, we now are looking for a new pattern. So the market rallies, pulls back to that support, and then pushes higher. And then right here, we start to see that change. We push up, we push down, we make new support, which connects back from here to here, and we just simply extend that from resistance to support, extend that line right, make a parallel line on the top, and then all of a sudden on the S&P 500, we get a new pattern. What pattern do we have there, ladies and gentlemen? A head and shoulder. Left shoulder, head, right shoulder. Now, a head and shoulder, I talked about there being 100 patterns in the market. The head and shoulder, so before I go on, so with 100 patterns in the market, do you want to trade all 100 patterns? Do you want to be an expert in 100 different patterns? Should you be? Why would you want to be an expert in trading the 99th least probable pattern? Why would you specialize in that? Doesn't it make sense that as a trader, you'd want to trade in the most profitable type of pattern? If you were a business and you were going to become a doctor, right? And you loved making money, and someone said, well, here's 10 different areas you could specialize in, sir or madam. Now, in this particular area, you're going to be able to charge $800 an hour, or you could be this type of doctor and charge $50 an hour. Which would you choose? You sure as hell wouldn't say, well, I want to do a bit of everything. You'd say, I want to spend every single hour of my day charging $800 an hour. So in the stock market, why don't we want to spend, to focus our time on the most probable pattern? Now, for your knowledge, head and shoulder is the most probable bearish pattern in a bull market. So it's an excellent signal when you're looking for market reversals. And when we get one in a toppy bull market, it's red alert. And if you look at the way that the S&P formed, there we go, there's the measurement from the head to the neckline. We duplicate that down below the breakout point, and that told us right there in January 2008, this market was potentially in big trouble. What time frame do I use to draw the trend lines? Weekly, daily, and hourly, but it really just depends on what type of trader you are, because a weekly pattern isn't relevant to a day trader, nor is a 5-minute chart relevant to a position trader. So all of the time frames are correct, but they're relevant within the context that you're trading in, if that makes sense. Okay. So let's have a look at going forward. Now, what we then have is we have a second head and shoulder. So we know that, so when does one trend end and another begin? Well, we see that this pattern ended at by measuring what the rules would tell us, that it should drop this much. So that tells us an important thing, that at that point on the bottom of that blue candle, that pattern was now finished. And that tells us another important thing to start looking at where the next pattern is building. So then we get an up move, support. So now we can connect our two bottoms. We can immediately make a parallel line on top. So we know that we've got a possible downward channel. Then we break out. We create a symmetrical top and pull back, and immediately at this point, we should immediately be thinking about head and shoulders. We can see the symptoms of that criteria, that we've got this nice up and down channel, this beautiful symmetrical rise and fall, and that is bang on. Hey, we've probably got a head and shoulders again. So once again, we're now waiting for that. We're going short the market, profiting from that drop, and all the way down. We could have captured that move from 1,300 down to 1,000, or a 300-point drop. We measure the head to the neckline. We duplicate that, 1,000 becomes our target. That's when the pattern resets, and that's when something new again starts becoming, which is an inverse head and shoulders, as a matter of fact. So why is that relevant to today's market? Well, if we go forward and actually look at the pattern that we're seeing as of the last few years, look at the same kind of time frame. We're going back about 4 or 5 years, like 2008 back to 2004. So look at 2011, Going forward, you can see we are in an upward channel this whole time. Upward channel, upward channel, upward channel. Okay, until there, until the 30th of July 2015. So again, almost exactly 4 years, same kind of rally, same kind of time frame, and then we broke down underneath that resistance. Okay, so then we know that that pattern has ended and another one begins there. Okay, so now we connect our two bottoms and project it to the right. And what we're seeing now is another potential head and shoulder. Now this is a weekly chart, so this doesn't mean we're not going to get bullish action week to week, but what we're seeing now is the beginning of another potential head and shoulder forming. Okay. If we go into a daily chart on the S&P 500, that was a weekly. If we go to a daily chart, we are basically at the test point right now of finding out how true that potential head and shoulders is going to become on the short term. So looking at the S&P 500 now, you'll see we have a left shoulder, a head, and then a complex right shoulder. Complex means that you've got two. So head and shoulders can be simple or they can be complex. Complex meaning two shoulders on one or both sides. Okay. All right. So we look at if we look at other correlating markets, we can look at the Dow Jones Transports. Dow Jones Transports also in a head and shoulders pattern. So we've got correlation across the market in terms of these potentials that as what's happening right now. Okay. So basically, that's why I believe it's the most important thing to do is to look at where is support and resistance, because if we know where that is and we do it the right way, then that's going to leave us with a shape on the screen, and that shape could be an upward channel, it could be a head and shoulders, it could be an ascending triangle, it could be a rising wedge, it could be a falling wedge, it could be a double top, it could be a triple bottom. There's lots of different patterns we could make, and then depending on what shape we see will tell us how to trade it. And that's ultimately what we're looking for. We don't want to be going through analysis paralysis. We don't want to be going to bed at night wondering if we should have gone long instead of short. We don't want to be going through endless amounts of different charts and time frames and indicators, and then looking at Yahoo Finance, and then reading the news articles, then going on stock twits, then asking your buddies. You're going to go nuts. We want to have rules that we can follow every single time. So the first most important rule is to understand that, and then to understand, once we've identified that shape, what type of pattern we're dealing with. Because algorithms don't see that, they see levels, and you need to as well. So flash crash reversed at very specific levels. For any of you who followed Adam Mesh, he's a colleague of mine, and when the flash crash happened on 2010, he was on BNN or CNN saying, look, this is the best thing that could have happened, because now I know exactly where support and resistance is for the next 3 weeks. I know exactly where I'll be buying and selling because the market told us today. So when we start to identify the pattern, there are two critical divergences of where our strategy could go. So when you look at the chart, what you need to decide when you've identified support and resistance is next whether you are dealing with an oscillating stock or a momentum stock. Now, it is very important to identify between these two things because the way you trade them are completely opposite. So let's have a look at oscillating stocks. Oscillating stocks are stocks that obviously move like the S&P, like for example in an upward channel or a head and shoulders. They move based on oscillating type moves. So straight down, straight up, straight down, straight up, straight down, straight up. Or, for example, if it was an upward channel, rising wedge, straight down, straight up, straight down, straight up, straight down, straight up. So basically, if we're dealing with an oscillating stock, what this means is that the stock, the most important thing that governs the stock's movement are the extremes. A static support line, a straight line on the bottom, a straight line on the top, a straight line on the top, straight line on the bottom. So that the extremes, the things on the outside, are what makes a stock turn. So we treat these very differently to a momentum stock, where in a momentum stock, it's not the extremes are actually not the most important thing. It's the moving average. So the stock will go up and hit these levels, pull back to a moving average, and then break through. Hit the next level, pull back to a moving average, and break through. So an oscillating stock we would short at resistance. A momentum stock we do not, because the most important thing governing that stock's movement is that moving average beneath it. Okay, so critical difference. In one strategy we short, in the other we're going long. We need to know that. So, for example, let's look at some oscillating stocks. Does anyone have throw a couple of stocks at me? And we can have a chat about it. Apple? Sure. Apple was one of our best picks this year, actually. For anyone who's followed us for a little while, Target, that was another one of our great ones. We'll look at that too. So Apple, on this day where you see the vertical line, on Tuesday, April 19th, we predicted that Apple would drop after earnings to $96. If anyone would like to watch that video, we still have that live recording on YouTube. And we said, okay, based on the way the market's moving, we feel the market is at the top of its head and shoulders that I showed you before, which it turned out being true. We looked at Apple, and so we said, okay, is Apple momentum or oscillation? Well, here's a great example. What is that? That is oscillation. So, and the easy test you can do is just look at the moving averages. Throw the 9 and 20-day moving average on. It doesn't work. The stock never pulled back to the 20, so the 20 is irrelevant. Didn't work. If we look at the 9-day moving average, the 9-day moving average didn't work as support either. Because look, it crossed below it here. It crossed below it here, here, and here. But one thing it did never cross was this straight line. Same with this one, apart from that little intraday high. So we see, okay, upward channel. Right. What is the rule for an upward channel? Well, we're waiting for 3 touches of support. 1, 2, 3. You'll hear me say that again and again today. And then we wait for the break. Bang. That's where we short. We were going into an earnings announcement, and the smart money was flooding out of the stock. So this was one that we alerted people to buy April 29th, $102 puts, which were up over 550% just over that 4 or 5 day period until earnings were announced. And that was purely rule driven. Nothing to do with any fundamentals at all, but just simply looking at what was the pattern, was it high probability, and what was the smart money doing. Baba. Let's have a look at that one. Okay, Alibaba. Right now, obviously, we are oscillating. We are in a expanding range triangle, which means directionless. There's no bias to this. This doesn't have a probability of breaking up or down. It means that there's excitement building in the stock because of the expanding range, but we don't know what direction. To know the direction probability, we have to see whether smart money is loading up in this consolidation zone or whether they're using the consolidation to load out, to sell off. And we're going to talk about how we do that in a moment. It's actually by looking at the smart money. So to me, Alibaba looks like it's loading up. Smart money has shot up dramatically, even though price is going sideways. So we've got big divergence in the smart money level, which is measured by money flow. And because we have a dramatic shot up, this tells us that the push is to the upside. Smart money is loading up. So Alibaba, definitely an oscillating stock at the moment. To apply smart money to Apple, by the way, you'll see that's that pattern, because look, as Apple went up and its prices went higher highs and higher lows, look what happened to its smart money. Smart money completely wet the bed. But once we've identified that a stock has oscillation going on, First Solar, nah, not a good example there. We'll come back to a few of those. The thing that we want to look at is we want to find out, okay, well, if we've identified a stock is oscillating, then where do we want to trade it? So when you look at a stock and you've determined it's oscillating, instead of saying, right, what should I do with it today, what you want to do is replace that with the question of, do I want to do anything at all? And if I did want to trade the stock, where would the perfect place to buy it be? So I think ERJ was a good example. ERJ. I'm thinking of something else. We'll come back to that. But basically, when we're looking at the oscillating, we want to find out where the most powerful level is in the chart. So when we're looking for potential entry zones for a short or a long, we want to find where the best possible trade for that stock would be and wait for it. So what is the strongest, most highly probable entry point for an oscillating stock? Well, what we want to do is we want to find levels where we've had an extremely sharp and aggressive change in direction. So, for example, a lot of people who like to trade oscillation will say, well, I look for double tops. Well, there are 4 types of double tops. You can have Adam and Adam double tops. You can have Adam and Eve double tops. You can have Eve and Eve double tops, and Eve and Adam double tops. Did anyone realize that? So when we talk about there being 100 patterns in the market, this is why double tops aren't just one pattern. There's actually 4 types of double tops. So which one do we trade? Well, this ranks 13 out of 100 by our ranking system. This ranks 47 out of 100. So why would we ever trade this if we could trade this? So what makes this more strong? What is the DNA behind the strength of that pattern? Well, basically, if you think about it, the strength of a reversal, if you have a stock that is plummeting, right? Plummeting, going straight down, and let's say it's trading $100 million a day, or maybe $500 million a day. That's a lot of power, a lot of money pushing it down at a rapid rate. And then let's say that stock comes to an instant halt and then goes straight back up. So you can obviously tell by now I like using analogies. So let me use another one. If you had a 100-ton truck going at 100 miles an hour down a freeway, how much power would it take to bring it to an instant stop, turn it around, and then send it in the opposite direction at the exact same speed? Instantly. You know, Superman doesn't even have that much strength. We would be dealing with immense power. Now, who has that kind of power? Well, if 80% of the market is high-frequency trading, that can't happen unless the high-frequency trading goes from sell to buy instantly. That will change it around, because that's exactly what happened with the flash crash. So when we see these very, very, very dramatic reversals, that tells us that that is the fingerprint of smart money. So strong, very aggressive, powerful reversals is what we're looking for. The second thing we're looking for then is, okay, so once we've found that, let's say we look at the chart and we find one of those levels. Well, when do we trade it? Well, what we do is now we're looking at the frequency of how often it's hit. So what do you think? Let's say that we spotted this on a chart. Let's say that this is $100 and we see that it went from 100 to 130 in this kind of very powerful move. So what do we do now? Do we wait to trade it there, or there? Like, what do we wait for? Are we waiting for more touches to get confidence in that support, or less touches? Where would you feel most comfortable buying that? 1, 2, or 3? Now, whether you're trading the stock, options, doesn't matter. I mean, this is where you buy your $120 calls or $110 calls or whatever the case might be. The answer is 1. Now, the emotional response would be 3 or 2, because as humans, we like to feel comfortable. And the more touches of support, the better we feel about it. Kind of like if you were betting on a horse. You say, well, that horse has won 5 out of its last 5 races. That horse has only ran one race. It did win it, but it has less track record. Let's go with the one that won the last 5. Right? Emotional logic tells us that's the right decision. And the smart money know that. So basically, the more time support touches, the weaker that support becomes. So 1 is the best because we know the support's there. It's only touched it once. That's going to be the most powerful. The next best will be 2. And by 3, we wouldn't trade it at all. And that comes back to the rule of 3 I kept talking about earlier. After 3 touches of support, it's much more probable it will break than hold. So, quick summary, what are we looking for? We are looking for oscillating stocks with static levels, and of course, as I indicated before, moving averages are therefore ineffective. So if you are looking at an oscillating stock and you're using a moving average as your entry signal or your exit signal, you will most likely be losing money. They just don't work on an oscillating stock. Moving averages only work on momentum stocks. So that's the summary. Fresh levels, powerful levels, and previous strong levels of buying. And obviously then you can get into your extra stuff of correlation. Examples of these types of charts. Aaron's is a great oscillating stock. You can see here, these are the kind of levels we're looking for. Where we've just basically come to 2650, bang, up to 32. Back to 2650, bang, up to 30. Back to 2650, bang, up to 32. I mean, we're dealing with $30 million a day that can move 20, 30% and then just go straight back down. That's high frequency. Those are the levels we want to anticipate. And then we can go into indicators. We won't go into that now. Because I want to get to the live markets and start looking at how we trade these current conditions. So momentum is, of course, the opposite. That is where we get into momentum indicators. This is where we are not buying the static lines. We're not shorting it. We're not catching a falling knife or shorting a stock that's going up. We're waiting for it to reverse. So examples of momentum, where you see the moving averages catch. Here again you can see the moving averages catch. I mean, I'll use some more recent examples. We can look at things like CLMT. I'm holding calls in this at the moment. If you look at the way this stock has been moving, just delete these lines, you can see that the stock went from oscillating, where it was just kind of shaking back and forth, and then bang, gap down, and look at how the stock interacts. Every single day, it touched the 5-day moving average, never broke through it. Let me see if I can, I'll zoom in a little bit here for you. We'll need a new project here. So every single day you can see it kind of touching the moving average, touching the moving average. A trend line wouldn't work here. It's going to cut through candles. It doesn't explain the stock's movement. What does is the moving average. Therefore, it is a momentum stock. That is the most important thing holding it down. So as soon as this broke through resistance, bang, right there, it has now overcome the only thing holding it down, which means this is time to enter. So when the stock broke through that 380 point, this moving average, I went in and bought July $4 call options. And just in those last 4 days, we've made over 100% return. And it was a very simple reason why. It's a momentum stock, and it's overcome the problem. There's momentum for you. Here's another one, CLDX. This is also momentum, with a little bit of oscillation as well. So there's the oscillating level, broke through that, broke through the moving average. So as that went through 395, that was an entry signal for us. 395 now up to 457. Yeah, I'll show you a couple of older ones so you can see a bit more of a longer term chart. I can go back to my normal chart now. Again, same kind of thing. I'll delete the lines. There you go, momentum. Look at how the stock's dropping. Bang, tag the moving average. Bang, tag the moving average. Every single day, touching the 5-day, never breaking through it. Breaks through it, hits the 9, holds down. Breaks through, hits the 20, holds down. Breaks through it all right there, there's our entry point. Okay, on the short side, same strategy. This is one that I'm holding puts in, PII, Polaris. We were oscillating upwards. So we had this tremendous short covering rally. Polaris rallied, 1 touch, 2 touches, 3 touches, broke down. Still oscillating, so no trade here. Rallied up and then broke down and took on momentum mode. All the moving averages now started to work. So I went in and bought $90 puts and still holding those at the moment. But that's momentum versus oscillation. Okay, and so then the final checkpoint that we want to look at now to bring this all to fruition is smart money. So obviously we want to look at what is the pattern, where is support and resistance? First, most important thing. Once we know support and resistance, we know the rules. So we can say, what pattern does that make? Is it a pattern that we are looking for? Is it a highly probable pattern we want to trade? Yes or no? Yes? Okay, what are the rules to trade that? Great. Final step, where is the smart money going? Do we have a really added advantage, an extra bit of je ne sais quoi that gives us an extra edge? And that is where we get the smart money test. So the smart money is what I showed you before in terms of Twig's money flow. So we'll go back to the S&P 500. For example, Twig's money flow tells us where there is an accumulation of several indicators, and we talked about them earlier. Is the stock making higher highs and higher lows? Okay, so that tells us if there's an uptrend or downtrend, technically speaking. But then it adds all the other important qualities. Is the stock closing in the top half of the range or the bottom? Is it making those new highs and lows? Is volume coming with the move, or is it selling off into the move? And that's what gives us a true depiction of where money's going. So smart money, as you can see at the moment, is moving counter trend to the direction of the market. So we have a divergence. Okay, and we talked about that earlier with Apple and so forth. Don't see the chart? Oh, my mistake. There we go. Here, I'll redraw that. So you can see the direction of smart money is going opposite the market. All right. So looking at the smart money then becomes the key thing. So now let's bring this full circle. Let's bring this into to current market conditions. Where are we now? Basically, we've been constantly fed with hype. Now, I'm not saying the market couldn't still go up, but we are at a very tenuous position. The Christmas rally never happened. Often when we are being told the markets are the most bullish is typically when the smart money is selling off. Because if you own billions of dollars in the stock market, you sure as hell want everyone to believe it's the best time to buy if you've got $1 billion worth of stock to sell. And here's the good thing. You control the media, you control the news, and you're on TV every day talking about it. Think about how many billions and billions and billions of dollars Goldman Sachs, Merrill Lynch, all of the major firms have been fined for recommending to go long on stocks while they sold their own positions. You know it happens. They pay the fines though. So what? We're constantly being fed with noise. So let's come back to the original statement. What's happening now that we can measure? Well, you've already probably heard from the previous speaker. I'm sure you're going to hear from other speakers today that we've got big problems. I won't reiterate all of the fundamentals, but we've got big problems in the overseas markets. China's yuan is devaluing, so on and so forth. Next step is that bankruptcies happen. Highly leveraged companies start going bankrupt. Oil companies, credit already tightening. There's massive layoffs going on as companies go into survival mode. Consumer confidence and spending has already contracted. For the first time in a very, very long time, the average US consumer is more likely to save money than spend money. That ratio flipped just a couple of years ago. That hasn't been the case in decades. The average US consumer no longer overspends. They're more likely to save. Liquidation in the stock market occurs. We are already seeing that. In the middle of March 28th, Bank of America Merrill Lynch released a report that the highest level of equity redemptions has occurred since 2008. The longest 5-week streak also has occurred of selling at that time since 2008. People are getting out of the market because there's a big bubble that happens to pop when things collapse. The bubble is estimated to be $600 trillion. That, by the way, that number is more than all of the real estate in all of the world added up. So why would you go out and buy a company that's trading at 2,000 times earnings because they expect to be the next Google or blow up with some amazing earnings multiples? Why would you buy a stock like that when there's no confidence in the economy growing at this point, when there's huge fear in the market, and companies are contracting and selling off? So far, we've had a huge drop in the beginning of the market, and then March, we had this incredible rally. But what was the rally based on? Are we really in a bear market or a bull market, and how long will it last? Well, let me talk about. Let's go back to the smart money. The backdrop of this market is that this is a ratio of insider buying versus selling in March. Okay. Insider buying versus selling in March. The red, by the way, is selling. That is how many insiders bought versus sold in the month of March when the market rallied away. Let's go forward a month. April, That is the insider selling versus buying ratio. May. Let's go to current month. And look at where it's selling is. Technology, financials, services. Let's go to May. Technology, financial, now healthcare, services. What if we believe that, again, I don't believe my opinion matters at all. You know whose opinion I do care about? The people that run the Fortune 500 companies of the world. The people know what the next quarter is going to look like and the next 2 quarters are going to look like. The people that know that how much factory outlet shipping is going to take place, and that Macy's isn't buying as much stuff anymore. That Target has dropped all their orders because they're not selling anything. That the people that know the economy best are the ones that run it, wouldn't you think? And if you start to see people that are selling their own companies in massive droves, I mean, what do you think the ratio is here from selling to buying? Look at the difference. What would we say? Maybe 50 to 1? Crazy stuff. That's what the smart money is doing. And the scary thing is that everything I've told you this morning, are exactly the same things that happened in 2008. And a theory of insanity is to do the same thing again and again, expecting a different result. And I talked to a client of mine last week about this. He said, "You know what, John? The scariest thing is there's a lot of commercial real estate development. There's other blokes I've talked to in residential real estate development that are all basically in the same industry, and they're all getting out. And they're saying, look, the market, this is a very toppy market. This scares the hell out of me." And he said, the scariest thing, John, is that everyone's going to get caught by surprise. Now, they've learned nothing from 2008. Now, I'm not saying the market's going to crash tomorrow, but markets never do. I mean, just because it hasn't crashed today doesn't mean it won't next week. For anyone who's seen the movie The Big Short will know that just before big drops, the most manipulation is going on because it's the exit door for smart money. So the people that make the most amount of money aren't the ones that get in halfway down and go, now Lehman has gone bankrupt, now I'll look at the red signs, now I'll start shorting, now I'll get out of my longs. It's too late. You can't wait till the sky falls to look at the warning signs. The people that get in that make the most money are the ones that are prepared for it. You can't build, in other words, you can't build Noah's Ark when the flood's already there. So what I've been talking about for the last few months is preparing for what's coming to a head and shoulders, pardon the pun, today. So those are my ideas. Now, I mentioned I would show you one last thing, which is how to predict the market. Now, this is called open range. So with open range, this is one of the most powerful strategies you can possibly use on the S&P 500. And it's basically by looking at something very simple, which is by saying, okay, let's look at the first trading day of the month and the third Friday, options expiration. Now, this will tell us to 80% degree probability where the market will go, which bias to take for the following couple weeks. So let's go back to February. Okay, February 1st, let's start there. The range of February 1st, the first trading day of the month, was the low here and the high there. Now what we're looking for is a close above or below that range to tell us which direction to trade in. We broke below, so then the bias is negative. And so then that bias continued. What was options was the 19th. Okay, so then that told us to go short, and then that bias reset on the 19th. We then closed above that range. that tells us to go long. Okay, that worked. That then reset March 1st. We closed higher, long again. Okay, next, March 18th. Okay, reset. We closed above here. We were inside, back and forth, closed above there. That told us to go long again. Reset. April 1st. We closed within. Back and forth in this range. Closed above there. That told us to go long. April 22nd, range reset. We broke below that, right at the head and shoulders. That told us to go short. And that's, for example, one of the reasons we were so favorable on the short on Apple, because open range was negative. We're at a head and shoulders in the S&P 500. It was all good stuff. Now, if you go back 3 years doing exactly what I'm doing now, you'll see that this is accurate up to 80% or more of the time. It's bang on the money. Now, so most recently, Thursday, May 19th, open range reset. We closed above. That told us to go long, so we scanned only for long stocks, and bang, here we are at the top of the market, taking advantage of a beautiful upswing going long. Okay. So basically today is the most important part where we reset open range. So I'm going to have to start wrapping up here, guys. So let me get to what I'd like to offer you all. The most important thing is what we talked about, is how to determine a strategy in the market. And what we want to do is we want to tie this all together then into a start through finish process. And this is where scanning comes into place. I mentioned earlier that people don't have any rules and people don't have confidence in them. Well, that's because there's so many systems out there that it's impossible to learn them all. What you really need to do is to focus on, one system for long and one system for shorts that's going to be extremely powerful, that focuses on the highest probability scans. We don't want to be focusing on doing lots of work. We want to be focusing on doing efficient work. Okay, so in looking at and how we do this, we need to have consistency in our scans, consistency in our, and that's what I'd like to invite you to be part of, everyone. What we have is what we call Finding the Perfect Storm workshop. This is the course that we are most proud of. It's what we have been focusing on for the last 12 months, and it is basically a scanning workshop where we will show you how to scan for the highest probability setups, so that every day you can just sit down in front of your computer. You can run a series of tests to say, should I be going long or should I be going short, that aren't based on opinion, that are based on things like open range. And then you will go into your system and run one of two scans that will instantly show you the stocks that have that highest probability of going up or crashing. And of course, right now we are looking at both sides of the equation, but a lot of stocks on the short side. Once you have that list of stocks, we don't just say up to you to do what you will with them. We then show you how to pick the best one. So if you get 10 stocks in the scan, how do you identify support and resistance? And then a 5-step process to decide exactly which is the best one to trade. We give you an Excel sheet to plan those steps out, everything, so that there's no confusion. There's no guesswork. Is the stock meet the rule, yes or no, from a very specific scan that finds the opportunities. As a bonus, We will give you a quick route to success. We've obviously been already doing this work. Last night I spent 9 hours going through almost every single stock in every watch list I've had for the last 3 months that have been ones from the scans from each night, and I went through all of the highest probability stocks. So depending on whether the market breaks through open range to the positive or the negative, you will get instant access to our absolute top stocks and options for whichever direction the market takes. So not only will you have the scans to find them yourself, but while you're learning that, given that we're at a critical point in the market, we'll give you the research that we've already done in terms of entries, exits, the options that we would trade, and everything you need. We'll also be doing live classes. This is a time where we could have some huge moves. So Tuesday and Thursday at 4 p.m. Pacific, 7 p.m. Eastern, you can join us where we'll be doing live classes where we'll be reviewing all the stocks we alert to you, as well as everything we're holding ourselves. We'll be reviewing the market, and we'll be also taking all of your questions about any stocks that you come across. But this is where the rubber hits the road, and the stocks we talk about are things that we are putting our own money in. So every day I also send out a video saying, based on the scan, this is the stock I'm putting my own personal money in tomorrow, when and where. And yes, I see a question about this. As a bonus, we will also be including the open range class. We do not sell this. We do not offer it in any of our courses. It's something we keep fairly close to our chest for obvious reasons. But over the last couple of weeks, we have been offering a special 45-minute exclusive class that covers specifically open range and how to trade it. I gave you the broad strokes. There are some very specific rules that give it that 80% probability, and we'll be including in this course not just the scanning, not just the pattern recognition, but also the open range, so that you can walk away from this with a complete strategy of knowing where the market's going, what scan to run to find the best opportunities, and then exactly how to trade them. So it's a full start through finish strategy that will allow you to walk away with some real value. When is the stock scanning class? You get these classes instantly. You'll get them tonight, and then the live classes are on Tuesday and Thursday. So Thursday tomorrow and Tuesday next week. And if you want to continue accessing that class, so there's 2 live classes and 4 on-demand classes, and then the open range is a bonus. And then if you want to continue doing those classes for a month, it's $9. You'll get the option to add that on when you register. In terms of the alerts, you'll get one immediately tonight. Are live classes recorded? Yes, they are. I'm going to have to finish here in a second, guys. I think I'm already over time. Yes, I am. Yes, live classes are recorded, and tomorrow will be the first live lesson. The other 4 lessons you get on demand, the most important one to watch first is the one on scanning, which is the very first lesson that will give you the scans so you can start running straight away. I won't have time to read you the testimonials, but look, the results really are speak for themselves. This was, I mentioned we traded target. This is just an email from the other week. Wanted to thank you for your diligence and for sharing your exceptional analytical skills with the ignorant masses. I just sold my May and June target puts for a $12,000 profit. Got into target late last week. May puts were up over 500%. ZUMZ are almost 200%. I'm pinching myself. My wife thinks I'm a genius, and of course I let her believe that. Love you guys. But this will, there's the details. I obviously have to finish up here and pass the mic back over to Dan, and so he can prepare for the next speaker, which I'm excited to hear. And but that is how you get in contact with us. And to register, simply just go to the link at the bottom of the page, acornwealthcorp.com/storm. As you can tell, I love to talk, so I'd love to talk to you some more, especially in these very exciting market conditions. So thank you all for your questions and your involvement. It's been excellent. And thanks once again to Winvesting for a terrific session today. And I'll pass it back over to Dan.